Welcome to the Up Your Assets podcast. I'm Ray Ferrara, CFP, and the founder and executive chair of Provise Management Group, LLC. Provise is a registered investment advisor with the Securities and Exchange Commission. We serve about 1,100 clients in over 30 states and manage about $1.9 billion on their behalf as of September 30th, 2024. You can learn more about Provise by going to provise.com. This series of podcasts is broadcast on the second and fourth Thursday of every month. This is an educational program and is not designed to provide personalized individual advice. Having been in the industry for over 50 years, there isn't much I haven't seen, good and bad. And as a result, we have more people to interview than I can possibly count. We do not endorse any products on this podcast, nor do we collect any fee from any of the people we interview. And in case you can't tell by our name, Up Your Assets, we intend for the podcast to be edgy and fun. So let's get started. The 2024 presidential election are just a few days away as we record this, and both of the candidates have desperately tried to convince the voters that they are the best suited to lead the American economy for the next 4 years. But does one candidate or one party have the moral high ground on which to stand? Everybody frets over the policies of the candidates, and they worry about the quote-unquote wrong person being elected. Regardless of the outcome of the 2024 election, the podcast today attacks the question, does it matter which party and or person are in the White House? And to get that started, with us today are David Yeske, CFP and PhD, and Yusuf Abugideiri, CFP. David and I have known each other for the past 25 years and served on several industry boards together. He is one of the founders of Yeske Buie with offices in Vienna, Virginia, and San Francisco, California. Yusuf is the chief investment officer and a partner of the firm. They've written a paper on election season, Does the Market Care Who is President? Welcome, David and Yusuf.
It's good to be here.
Yeah, thanks. Gentlemen, looking at your first slide, what spurred you to do this research in the first place? Why go to all the trouble?
So I've worked through 4 presidential election cycles. Dave, you've seen maybe closer to 9 or 10 at this point. Clients start asking the question about a year ahead of election day. So there's no shortage of interest in what the market might do if so-and-so or the other so-and-so, or if it's a 3-party race or the individual race, what might happen if whoever wins. And so we have been doing this for some time and making sure that we have ample information to provide a clear story that while it matters who is president, the market may not really care.
Yeah, the key, anything that looms large in the news, clients assumes will loom large in the economy and the markets. And so the questions inevitably arise. And there's nothing bigger in the news right now than the presidential election, let's face it.
I think we've all grown a little tired of it all, and we're anxious for Tuesday to come and go. But it may not end on Tuesday. It probably is not going to end on Tuesday night. So here we are, early November, going to your next slide, with the elections just a couple of days away, as we were just talking. How's the market done so far this year, considering all the anxiety over the elections? And David, you were really kind of addressing that in what you were just talking about.
Well, then actually, I'll let Yusuf take us on a walk through some of the key market segments. But, as you will hear as he lays out the details, it's so far it's been a good year. The market climbs a wall of worry, as the old Wall Street adage goes.
Exactly.
It has. Year to date, I can talk about our portfolio. It's up double digits. Even through October, which is a bit choppy, the stocks in our portfolio up 10%. And what we've observed through the year so far is that, aside from the S&P 500, or really if we want to single out the Magnificent Seven, big tech or whatever you want to call those stocks that represent some 30% of that index. International stocks we've seen been dominant relative to U.S. stocks this year. Not the case in October. International took a bit of a beating relative to the U.S., but year to date, they still hold the lead.
Right. Well, going to the next slide, at a high level, what have past presidential election years brought to the markets?
Generally positive returns
You
on
know,
a fairly consistent basis.
I used to say, Yusuf, that that first year, everybody, at least 50% were happy. Unfortunately, with the electoral college and the popular vote, that hasn't been true anymore. The last couple of elections could be that you won more votes, but you didn't have enough in the electoral college.
Right. And then, irrespective of the outcome of the election, in terms of market returns, I think everyone has been happy, whether it's in a presidential election year or the year subsequent. We've seen a trend of positive returns, significantly positive returns if we talk about U.S. markets. So, the research there being done by the folks at Dimensional, who have the takeaway being that, again, irrespective of who wins, the market tends to process that as one variable in a sea of variables, and then chugs right along forward.
So
the thing that we always bring up is that who's president is not a non-consequential thing, but we may be answering the wrong question if we're asking what is the effect going to be on the economy and the markets. It's consequential, but maybe not in the way that people assume.
Interesting point. And again, if you go back to when President Trump was elected in 2016, everybody thought that oil and gas sector would be dynamite for those 4 years, and it was probably one of the worst performing sectors. And then you bring in a green president in President Biden, and the last 4 years have seen the oil and gas industry do extremely well in the market. So it can fool us all. Well, let's take a broader view of it for a moment. Let's go back to even before the Great Depression. How have the presidents from Coolidge to Biden done?
So maybe we'll single out a couple instances where markets haven't had positive return at the end of a president's term. There's only two instances, Nixon and George H.W. Bush. Aside from that, in every other presidential term, over the past 100 years, markets have ended higher than they began, irrespective of party or whether it was a single term or two terms. We've seen that markets tend to rise in the aggregate, and that's played out, again, irrespective of who's been president.
Isn't it funny that historically we think that the Republican Party is the one that's the business party, and yet the two presidents that didn't have positive returns were, in fact, Republicans. The other use of the thing that I want to talk about is, as we look at this slide, is that it's interesting how some of those big dips that we think about on a historical basis, how small they become when you look at it on a long-term basis. And as I said for many years in talking with clients, the market is like an investor climbing a flight of stairs with a yo-yo. We all have a tendency to look at that yo-yo going up and down, and we fail to see the investor walking up the stairs.
I love that metaphor. And there's another one I love, which is the dog walker. If you watch someone walking their dog across a park, what's going to be the best indication of where they're going to end up? Watching the walker or the dog? Because the dog is all over the place, right? If you watch the dog, you're going to have no clue what's going on. But if you watch the walker, which is like the deep fundamentals underlying everything else, what are the deep regularities in the economy? What are the deep regularities in the market? That's what's going to determine your destination, not the back and forth of the dog at the end of a long leash.
Well, looking at the next slide, Yusuf, to your point, we've had 12 presidents kind of bringing it into modern times since 1960. Who did the best? Who did the worst? Republicans, Democrats? You already mentioned two of situations with the Republican presidents, but what makes it look the best?
We can talk about the two instances where we see the largest positive returns, those being in the Clinton presidency and the Obama administration. And yet,
Wait a minute, wait a minute. So the two worst have been the two Republicans, and the two best have been the Democrats. That's not the way common people think about it. It's just the opposite of what.
well, and I don't know that you can blame or credit the president in either case, right? I mean, it's a sea of factors that influence market returns. Who happens to be president at that time is just maybe coincidence, right? I mean, I don't know that it's George H.W. Bush's fault that during his 8 years in office, we had, he caught a part of the dot-com meltdown. He certainly, 9/11 occurred, of course, during his presidency, which caused some volatility. And then was also around for the beginnings of the housing meltdown, which I don't know that we can blame on him either, right? So a run of bad luck contributing to some pretty terrible returns. And I've made this joke in the past, but if we want to look at the Clinton administration, whether or not Al Gore invented the internet is besides the point. The fact that we had such a fabulous run of innovation leading up to and through his presidency, see a lot of market growth, but I don't know that we can give Al or Bill all the credit there.
Well, let's put all of that in our next slide, puts all of what you're just talking about into a graph. And again, we see the same thing. We see over time that market going up, and again, not making any difference. But Yusuf and David, the president is only part of the government, and a lot of policy, et cetera, is set by the Congress. And some would argue that it depends even more about who's in control of Congress than it is about who's in the White House. What are your all's thoughts on this?
And you're now all out this why ever.
In a word, no, it doesn't matter. But Dave, would you like to offer something?
I mean, it's just that we can look at. I mean, if you look at history, whoever was in control at any given time, the results have been the same. This is one of those things where, again, who controls Congress is consequential. Who's in the White House is consequential, but it doesn't necessarily mean it's determinative for what's going to happen in the economy and the markets. Because just in the U.S. alone, you have about 300 million citizens going about the daily business of earning, saving, spending, and investing, and those individual decisions aggregate up to what the economy is going to look like, and they influence it far more than any policy decision that comes out of Congress or the White House. And so this is the thing we have to continue to look at, is like, where does it really come from? And it comes from the actions of individuals, of 300, in the case, again, just of the U.S., of 300 million, individual actors going about the daily business of their daily lives. And so they're not unaware of what's going on in the White House, but its ultimate impact on the economy is swamped by people managing their lives and taking care of their families.
Well, Yusuf, if we go to the next slide, we put it all together. We've got the presidents and the Congress. What mix seems to come out? What mix seems to come out best?
So, I'll offer maybe some broad comments, and then we'll look at the slide here. But risk and return are related. Uncertainty feeds risk, or risk is maybe perhaps a measure of uncertainty in so many ways. As the story goes, when you have a divided Congress, they can't get as much done. So the expectation is there won't be too much policy change, which maybe removes some uncertainty from the equation. The chart, whether or not there's a causal relationship there, we're not going to make that comment. There does seem to be a coincidence in that when you have a divided Congress, again, irrespective of which party is in the Oval Office, that's when you're seeing the highest returns. So the slide focuses on a couple variables here. Again, certainly doesn't tell a comprehensive story, and yet there's a pervasive pattern that we see here, and interesting to note.
Well, as we look ahead to next Tuesday, regardless, I guess we can conclude from this slide that regardless of who sits in the White House, we want the Congress to be divided for our market returns. That politically, that may not be what some people want, but for their pocketbooks, it looks like there's some type of correlation.
Divided government, means stasis, and that, when there's little action coming out of Washington, the economy has much more freedom to go about its daily business. That seems to play out. The data seems to support that.
Yeah. Well, if we turn it to the broad economy itself, then does it make a difference as to who's in the White House? Or, David, perhaps as you stated earlier, 300 million plus people going about their daily lives are what really makes the difference.
We think that's what really makes the difference. We as Yusuf can tell you, at Yeske Buie, all of our thinking and all of our advice is founded on a fundamental worldview that is informed more than anything else by our beliefs about human nature. And we believe that human beings are fundamentally growth-seeking. They're resourceful, they're resilient, they're ingenious, they're problem solvers. And so no matter what you throw on their path, whether it comes out of Washington or it comes out of somewhere else, whether it's a global pandemic that Washington had nothing to do with, or it's a change in legislation that Washington has everything to do with, whatever the impact, human beings adapt. And in adapting, they overcome whatever difficulties that outside force represents. And so when we think that upward slope of every chart we've looked at thus far is really more than anything else, it's a manifestation of human resilience and human ingenuity. That's our fundamental belief, and we found everything we do on that belief. Human nature trumps anything that's going on in Washington.
Well, that's great. So if we go to the next slide, excuse me, Yusuf, go ahead, please.
No, I was just going to say a critical facet of human nature is you're going to consume, right? I mean, the measure of economic activity, gross domestic product, 70% of it is consumption. And regardless of whether or not you're spending and about in the world or from your home, as people kind of had to during COVID, almost nothing stopped the American consumer from continuing to spend money. And this is one way of assessing that resiliency that Dave was talking about.
Well, Yusuf, we started looking from Coolidge to present day, and then we narrowed it down from Kennedy to present day. Let's squash it down a little bit because there's a lot of recency bias that exists with investors. So let's look at the last 24 years in this next series of slides. Bring all of it into a modern focus. What's happened with these last four presidents that we've had?
So we thought it would be fun to do this review over the past quarter century because it provided, in so many ways, a fair opportunity for assessment. You have two presidents of the Republican Party and two presidents from the Democratic Party, each one with a two-term presidency and the other with a single-term presidency. And we don't have all the numbers, obviously, through the end of current President Biden's term, but we're doing the best that we can with the information we have. And we found it fascinating just to observe, and I know we'll look at each of these individual presidents' terms here as we go through. But I'll give away the punchline at the end. Things worked out really nicely, across all four presidents' respective terms in the aggregate. So fascinating to observe, even in the short run or the long run, or even an intermediate period, the results have been the same.
So let's go back and look at each of these four individuals. The first one, of course, is President Bush that you've already talked about a little bit.
Yeah, I mean, really bad luck in terms of occurrences in the world. I know on this slide, we're showing how our portfolio performed relative to the All Country World Index, which is our benchmark. So certainly pleased to report that we had good returns in that period. But whether or not you like President Bush or whether you voted for him, I don't think you can deny that the world was a really volatile and in a lot of ways scary place during his presidency. And that's reflected in how the market was processing all the events of that day, those days, and what we saw play out.
I mean, his presidency almost began with 9/11, and it ended with the Great Recession. So it's like that's a heck of a set of bookends.
Indeed. And, David, you and I were together when 9/11 occurred. We were in San Diego for a conference, and we'd gotten there a couple of days early. It was a very dynamic time for sure for all of us in America. And Yusuf, as you said, timing makes a big difference. Well, let's fast forward now. After 8 years of President Bush, we've got President Obama.
Fascinating. I don't know that during the time anyone would have attributed a run of good luck to his presidency beginning in the depths of the Great Recession, but markets couldn't have gotten much lower now in terms of a starting point. So they had nowhere to go but up. And obviously he and the rest of the team that he was working with to make decisions, and we can talk about the policy decisions and spending and whatnot. Ultimately thing got back on track. And as Dave was talking about, the human resiliency started to show up right at the beginning of his term and kind of ran all the way through the end. And that shows up in the returns as well.
Well, certainly when we're doing work with clients, we talk about the sequence of returns, and the sequence for Obama was perfect, almost the bottom of a market, and then a market that just seemed to keep going up for the entire 8 years. And then I'm sorry, David, go ahead.
Well, I was going to say, what Yusuf and I like to do oftentimes when talking to clients is we'll generate a graph of either the market performance or their portfolio's performance. They obviously mirror each other in many ways over a period like Obama's 8 years. And you could look at every little wiggle and you could talk about the crisis of the day. You could, that little wiggle is the Greek debt crisis. Oh, look, that little wiggle is the fiscal cliff. Oh, look, that little, and yet it didn't have any impact. It didn't have a negative impact on the long run trajectory because the deep fundamentals were untouched by the surface variations. Even though the Greek debt crisis and the fiscal cliff and all the other crises of the day, they filled the newspapers, they filled CNN, they were all around us, and they created anxiety in the markets and elsewhere. But it was not long lasting. The impact was transient.
So now we fast forward to President Trump. He's been certainly touting his 4 years with the economy. Give us a little flavor around that.
He caught the last third of the longest secular bull market in history. And this is not to detract from former President Trump. It's just to say, the facts. The technological innovation that had occurred that spurred so much of that growth with the companies that are now the most massive the world has ever seen, your Apples, your Amazons, and so on, all that was bubbling well before he launched his presidential campaign. So just like we looked at Obama and Bush before him and attributed so much of what we saw in markets to things that had been occurring outside of their purview, I'd say the same would be true for President Trump. He didn't invent social media. He didn't invent the internet. And the way that we interface with social media and the internet very much has had an effect on the performance of those companies. And the performance of those companies has driven market returns unlike any other force over the past 10, 15 years. So,
yep. And then,
although economically he ended with some, less than stellar statistics, because his presidency also ended on the cusp of one of the worst pandemics in 100 years. So, again, there's so many things presidents don't control. There's vastly more they don't control than what they do control.
In spite of what they'd like to think, David.
Exactly. Well, that's the thing is that human nature is to blame whoever's most visible, and that's the president. And in reality, they don't deserve the praise of a good economy or a good market any more than they deserve the blame of a bad economy or bad market. By and large, their policy changes will have an influence on the margin, but it's not really the main driver. It never has been, and probably never will be.
So let's wrap this part up by looking at a good portion of President Biden's term in office.
Yeah, I mean, similar to former President Obama, Joe's presidency, or President Biden's presidency, excuse me, started, as we were coming out of the COVID crash, right? And I think we learned that we were going to have vaccines available right around the time that the election was sorted out, or at least started to get sorted out. So that was certainly good news that inspired markets to be bumping up in the right direction, in addition to a number of other factors, right? I'm just pulling out one variable here. But, it's just interesting to note that when your presidency can start at a time that coincides with markets recovering from some cataclysmic event, it bodes well for returns because you're riding the wave upward.
So how have the economic indicators reacted through all of this on our next slide?
Yeah, this might be my favorite slide of the entire presentation here. And, if you're a fan of the ESPN 30 for 30 documentaries, a lot of the trailers start with, the phrase, "What if I told you?" and then start to describe a really compelling story. So the note that we had written here is that, what if we told you that over 4 presidencies, 2 from each party in a 20-year period, that, we ended exactly where we began in terms of employment and price stability, which of course is the Fed's dual mandate. We're at full employment, stable prices, inflation at, 2%-ish, 2.5%, and a healthy economy growing at an average clip of 4.5%. Despite having to navigate 3 recessions caused by completely different factors. It's, if anything, speaks to the resilience that aggregates up from those individual decisions that Dave was talking about, and is clearly observable at the national level. This might be one of the prettiest pictures I've ever seen. I mean, it's amazing.
Yusuf generates about 10 charts like this every day. Even before he was CIO, he was doing that.
Well, that's great. We'll go into our last slide, which kind of summarizes what we've been chatting about. And as my teacher wife would always tell me, particularly as it related to me, is for people to learn, you got to tell them what you're going to tell them, and then tell them what you told them. And then, and particularly, as I say, related to me, she said, then maybe you will understand when I tell it to you 3 times. So we kind of finished where we started, right back at the beginning. It doesn't make any, it is consequential who's in the office at any given time. But in terms of that, and David, I like the word that you used, the adaptability of the human spirit to make whatever needs to be done to continue to drive things forward. And of course, why all of us as financial planners, well, talk long term. And while 4 years in some respects seems like a long time, we go back to thinking about COVID. Actually, almost 5 years ago was the first time we heard it, and yet that feels like yesterday to a lot of us. So Yusuf, David, any closing remarks that you all would like to make? Okay, one of you go first.
Sure. I'll take it. Then, Dave, I'll leave you with the last word. It's fascinating when we get to do this kind of research and look under the hood and try to identify, the why behind the what of what we're seeing. And it always comes back to people. People solve problems. People are resilient, and people always think it's different this time. And the details matter. I don't want to sound dismissive here or arrogant, given that I'm only 37 years old, but I've seen a couple things. And, it always feels different, but the way that people respond in the aggregate ends up being the same way they responded since the beginning of time, which is they're going to face their problems, figure them out, and step forward. And there's no upside potential in betting on the other end of that, outcome spectrum. So we tend to focus on the probability that things are going to improve.
It's very well put. I mean, really, if you're ever inclined to be pessimistic about the wide world, you might be pessimistic about the election. You might be pessimistic about what's happening in your local precinct or what's happening in Congress, but don't automatically connect those to the economy and the markets. You look instead to human nature, what you know about human nature. And, as Yusuf said, it's not worth betting against human nature. It's not worth a bet against human resilience is a bad bet. And there's a long history of humans overcoming problems going back to the beginning of time. And so this is the thing. Don't bet against human ingenuity. It will overcome whatever's going on in the world, including what's going on in Washington.
Well, on behalf of our listeners, I want to thank both of you for your keen insights. The media is all about hyping who's going to be in the White House, but as we've learned, it really doesn't make that much difference. As boring as it might seem, the fact is a long-term, well-allocated and diversified portfolio has historically produced good results regardless of who is the president. And at Provise, we don't believe that it is necessary to take undue risk to help achieve those financial objectives, just as is true with you all as well. In addition, that additional risk, if it doesn't increase the value of your life, why are you taking it in the first place? And so stay the course. If you'd like to have a copy of today's slide, just send an email to info@provise.com. That's info@provise.com. And don't forget, every listener is entitled to a complimentary 1-hour consultation at either our Clearwater or Tampa office or by Zoom with one of our CFP professionals. Once again, David, Yusuf, thank you for taking time with us today. And thank you to our listening audience for viewing the podcast. Now, get out there and up your assets.